Now that Jay Robinson of InSource has provided you general information on long-term care, in addition to statistics for long-term care, are you thinking that you need long-term care insurance for your retirement planning? Well, I'm going to talk about the first option, which is self-insure the risk. And if that's sounding a little scary, then stay tuned for my next 3 videos that are going to provide even more options for long-term care insurance. And don't forget, I do have a link below. And if you click the link, it'll provide you statistics not only for your state, but also the city that you reside in. I am Darlene Hartman. I'm a CPA and financial planner with Money Concepts. For weekly retirement planning advice, in addition to annuity advice, be sure to subscribe to my YouTube channel and hit the notification bell so that you can get notified anytime I post a new video. So let's start with self-insuring the risk. Well, I have been promising you that we would talk about long-term care. So today is the day. And I have invited a guest speaker, Jay Robinson, who is an independent insurance consultant with InSource, to help me provide you information on long-term care. So I talk to Jay anytime I have a client with specific long-term care needs, because he has that direct relationship with the insurance carriers and know the pre-qualifications that are needed for each long-term care product. So on that note, I'm going to introduce Jay Robinson of InSource and let him take the presentation from here. Good morning, Jay.
Good morning. Thank you, Darlene. So, what are the 4 ways to prepare for long-term care? Well, 1, we can self-insure the risk. And we're going to get into each of these in more detail individually. But the 4 ways to prepare for long-term care in retirement is self-insure the risk, traditional long-term care, asset-based long-term care, and life insurance with a long-term care rider. So self-insure the risk. What exactly does that mean? Well, this is the default planning. If you don't have a plan in place, the default plan is there for you. This means that you are going to cover dollar for dollar any expenses that you have as it relates to long-term care needs. Everything is going to be paid out of your portfolio and or your income. That's not to say it's good. That's not to say it's bad. But what I'd like to do is look at the pros and cons of each of the 4 options. And the pros with self-insuring the risk, well, if we don't have insurance, if we're going to cover the cost, that means we're not paying a carrier any premiums. And that also means that if we are one of the 30% that don't need any form of long-term care, then we have no costs either. And we don't have to qualify medically, and anything that we have in our portfolio and our assets, if we don't need it, stays in the family. But the cons, as we go back and look at that previous slide, where care is needed by some of 10 to 14 to 19 years, we could run the risk of having to pay a lot of money, an unlimited amount of money, out of pocket, out of our assets, out of our income, if we ever need long-term care and extended care. We could spend down our savings. Think about that last example. If we had saved up $2 million because that was going to be enough to make our descent down, and we were gentleman number 1 who has now gone through $2.2 million, that means we've spent everything. And if I have a spouse, that means my spouse has nothing at that point because we've spent it all on my care needs. We may have to liquidate assets. We may have to sell things that we ideally would not sell. Here in Indiana, that could be farmland. We would have to liquidate assets to cover the costs that are needed for extended care. And go back to those slides a couple slides ago. Remember how I said 41 million unpaid caregivers? If we self-insure the risk, if we don't have someone to come in to take care of us or to help facilitate care, we're going to have to default to family members. I've seen this firsthand. My mother had to do this for both of my grandparents, she and her sisters. Family members will have to come in and take care of us. And the question is, what does that do between family members if one person's carrying the load and the burden while another is not?
I personally have a friend who is currently doing that with her mom. She is the primary caregiver. So I have learned firsthand how important it is to have some kind of assurance with respect to long-term care. But I have a quick question for you, Jay.
Mhm.
So many people that I talk to believe that Medicare will cover their long-term care costs. So is that true?
Great question. Many people think that Medicare will cover it, and Medicare is not meant for long-term care. Medicare is meant to help cover medical expenses. Medicare will cover a short duration. Usually it's up to 100 days as the focus is on medical care needs. It's not meant to cover custodial care, which is commonly what long-term care or extended care is. So it will not cover, after the 100 days are met, it will not cover care needs going forward.
Okay, thank you. Well, thank you so much, Jay, for taking this time. The presentation was very enlightening and informative, and I appreciate you spending this time with me. And if you're interested in obtaining long-term care, no matter which option that we discussed today, be sure to click the link below to apply to become my client. And also, don't forget, if you like this video, give me a thumbs up, subscribe to my channel, and share it with your family and friends. Let's get the conversation started on how you can live your best retirement while not outliving your money.